Is there a better way to build an index fund? I'm Jack Otter, editor of BARRON'S.com. I'm here with Chris Brightman, who's the Chief Investment Officer at Research Affiliates. So Chris, you work with exchange-traded funds in that you build the index on which they're based. And traditionally, any index really in the financial markets have been cap-weighted, which means the larger the company, the bigger its representation in the index. You've taken a slightly different approach. Can you explain what that is?
Sure. And first, let's examine that statement that you said, the bigger the company, the bigger the weight in the index. It's not quite true. It's actually the bigger the market price of the company, the bigger the weight in the index. A traditional,
fair point.
Yes, a traditional index weights by market capitalization, number of shares outstanding times stock price. Price is in the equation. We create an index that measures company size using fundamental measures of the company unrelated to its stock price. We use sales, cash flow, dividends, and book value. You weight big companies with big weights, medium-sized companies with medium weights, small companies with small weights, but you don't follow market prices. And that's where the advantage comes. We are not overweighting all of the overpriced companies and underweighting all of the underpriced companies. We're systematically selling those companies whose stock prices are going up and systematically buying those companies whose stock prices have fallen. Sell high, buy low, sell high, buy low creates a return advantage.
Now, quite often when a company's stock is going up, it continues going up. When you use this approach, do you end up giving up some of that advantage while Cisco becomes 80 times earnings?
It's an important point. And in the short run, there is momentum in the market. When a company's stock price has gone up versus the rest of the market for the past week or month or quarter, it tends a little more likely than not to continue to go up versus the rest of the market for the next week, month, or quarter. However, over longer periods of time, over years, there's mean reversion. Trees don't grow to the sky. Companies whose stock prices have been soaring over the last year or two tend to mean revert in future years. And this process of selling what's gone up over the past year and buying what's gone down over the past year takes advantage of this long-term mean reversion to create that approximately 2% return advantage relative to a cap-weighted index.
And so you've been doing this for about 10 years.
Yes.
I realize that there's some restrictions on how you can talk about performance, but you mentioned 2%. Over the 10 years that this has been in existence, you have seen a benefit from using your approach?
Yes, when we first published the ideas in peer-reviewed journals, we examined this idea across many different countries for very long periods of time and found very consistent results. And in the 10 years since the launch of the real live products following this strategy, again, many different markets in many different countries, the live results have been completely consistent with the original studies, delivering about 2 percentage points per year in higher returns.
Now, your approach obviously is proprietary. You guys do your own research. But is it possible to kind of put it in a bucket that people are used to? Does it tend toward the value end of the spectrum?
I think of it as using 21st century technology to do old-fashioned value investing. Very similar to the principles of Graham and Dodd.
That's a great way to end it. Thanks very much, Chris.